Right now, economic madness is unfolding in China. The world's second largest economy is slowing down. People are spending less and less money. At the same time, the real estate market is experiencing its worst crisis in decades. Inflation is fading away. And yet, despite all this, the stock market continues to grow. Over the past 2 years, Chinese stocks have risen by 70%. How is it possible that the economy is going through a structural crisis, yet stocks keep rising? On this channel, we analyze the main events and trends that are currently affecting the performance of our portfolios. We also share our own strategies, and in fact, that's what today's episode is about. Because for the past 3 years, we've been running our own strategy focused on Chinese stocks. And today, we're going to share our expertise and our views on how to invest in Chinese companies. Now go ahead and hit the like button. And of course, subscribe to our channel and click the bell so you don't miss the next episode. Dima, if you look at China's domestic economy, the first thing that stands out is that people have really started spending less and less money. Although after the pandemic, everyone expected that the Chinese would follow the European model. And in reality, that they would start turning all their savings into consumption. But that didn't happen. Why is the situation in China completely different?
That's exactly right, and we can confidently say that analysts were wrong in their forecasts. That's what you just mentioned. Moreover, there's even a term now, revenge savings. What does that mean? It means that after the pandemic, the Chinese became much more cautious. They are very worried about the future. They're concerned about their jobs, their pensions, and the value of their housing. This is especially noticeable among young people. There's a movement called FIRE. Its essence is that young people are trying to earn money as quickly as possible, to accumulate some initial capital so they can get out of the corporate rat race. I even saw a story that they have competitions, for example, where people try not to spend any extra money on non-essential goods for an entire year. In other words, everything is focused on saving and not spending. Extra money isn't spent on things you don't really need. Of course, all this leads to stagnation in domestic demand in China. It isn't growing, but at the same time, the overall economy is doing fairly well.
Well, weak consumption is only part of the problem. There's another issue as well, and that's the real estate market. That is, many companies in China have declared default. For example, the well-known Country Garden. Many private clients, I know, had bonds from this company. So what's happening in the real estate market?
This is a major problem in China's economy. Moreover, on average, historically, real estate has been the main family asset for Chinese people. And according to various estimates, about 70% of all Chinese wealth is connected to real estate in one way or another. And of course, when we find ourselves in an environment where for several years in a row, real estate prices have been steadily declining, it hits consumer confidence. And not only that, as you rightly said, some developers, including major ones, have declared default and failed to complete the projects that people had invested their money in and purchased. And in China, just like in many other countries around the world, it is common practice to buy real estate while it is still under construction in order to ultimately earn more or to buy at a lower price. And many Chinese people have found themselves in a situation where they are still paying their mortgages, but do not actually own the property itself. Undoubtedly, all of this has had a significant impact on the confidence of the Chinese in their future. It has affected their perception of their own level of well-being and inevitably has influenced their consumption. This is one of the reasons why domestic consumption in China is suffering.
And if people consistently spend much less of their hard-earned money, then accordingly companies are often forced to significantly lower the retail prices of their various goods or services to attract customers. And all of this leads to deflation. So what are the consequences in this situation? Yes?
This is really happening, and the situation is actually very dangerous. How does the consumer behave? They see that from month to month, from day to day, prices for goods and services are going down. Accordingly, they act rationally and postpone purchases, especially expensive ones. Because why pay today if in a month you can spend less? And companies are forced to keep lowering prices just to sell their products somehow. Moreover, it should be noted that for a long time, Chinese companies have been actively investing in expanding their production. And today, some of these production capacities are standing idle, while companies still have to cover their fixed costs. As a result, company profits decrease, profitability drops, and management is forced to make different decisions about future investment projects. They simply don't pursue them or reduce the amount of investment. They raise employee salaries more slowly, and as a result, the entire Chinese economy suffers from all of this.
Actually, Dima, it all looks like some kind of vicious circle. And as I understand it, the government sees that there is this problem. which is structural and unsolvable, and they introduce incentives. But as far as I can see, these incentives aren't working.
That's right. And there is a fundamental difference between how developed countries stimulate their economies and how China acts. What happens in developed countries? In them, as a rule, governments try to support consumption, either in extreme cases by handing out helicopter money or, for example, through tax breaks. That is, consumers feel this directly. They actually have more money and they spend it. How does China act? China uses more targeted methods of stimulation, and mainly they are aimed at supporting banks, supporting investments in infrastructure projects or in production. As a result, what do we get? The export sector of the economy is doing quite well, because business is being stimulated, but domestic consumption does not benefit from this in any way. Therefore, the consumer, in essence, hardly feels any government stimulus at all.
Well then, Dima, here's the main question. If there are such structural problems, why are we seeing such, one could say, a vertical growth of the stock market if we look at the last 2 years?
Well, let's start with the fact that publicly traded companies, which you can actually buy or sell on the exchange, are not the entire economy. If you look at the largest indices, all of them are weighted by capitalization, so the biggest share in them belongs to the largest companies. And if you look at the largest companies in China, probably as in most other countries, these are global corporations that earn money not only in China, but get the lion's share of their income elsewhere. They receive it from the rest of the world. In general, the global economy is doing quite well, as is the global consumer, so these large companies are less dependent on domestic demand in China. The second important factor is artificial intelligence. For several years in a row, the topic of artificial intelligence has been actively traded. Investors are revaluing companies that earn money in this sector and operate in it, ranging from companies developing LLM models to those manufacturing chips. And it's worth noting that in China, there are a lot of publicly traded companies that are directly connected to the artificial intelligence trend. This is the second reason for the revaluation of the Chinese stock market. Third, it's worth looking at the valuations. Not so long ago, the forward P/E ratio, that is the price of shares divided by company earnings, was around 8.5. This is a very low figure, both compared to developed countries and to other emerging markets. And at a certain point in time, several positive factors coincided. The AI theme was being traded and valuations were low. And on top of all that, in the market itself, for the second year in a row, we're seeing a trend where capital is flowing from developed market assets into emerging markets, and among emerging markets, the largest is the Chinese market. And when all three of these factors came together, we saw growth in the Chinese stock market.
I'd like to draw your attention to the fact that we run our own strategy for Chinese stocks. Over the past year and a half, it has earned 65%. And among emerging markets, we single out China as the most promising. Over the past year, the market has grown by more than 30%, and we believe that this growth will continue in the near future. And if you would like a detailed breakdown of our China strategy, leave a request via the link in the description of this video, and we will definitely get in touch with you. Alright, Dima, and probably the most crucial question, especially for those who haven't had a chance to invest in the Chinese market yet, what will drive the future growth of the market that we believe in?
Let's discuss in a bit more detail the factors on which our positive investment thesis is based. Let's start with the first one, which we've already touched on briefly, artificial intelligence. In fact, China is building its own infrastructure. And this is very important because they are working on developments at every stage, so to speak, of this process. The entire value chain in AI, from language models and software companies to their own chip manufacturing. And it's worth noting that at every stage, the results and the efficiency of the technologies that China is producing actually look really impressive. Another important point is that if you want to take a more pure exposure to artificial intelligence, it's actually harder to do this on the US public market. Because if you look at any more or less large company, they have enormous revenues and income, but the share of artificial intelligence in those is not very big. In China, the situation is different. There are a lot of public companies there that are engaged in, let's say, more specialized activities. And that's why it's much easier to make a pure bet on artificial intelligence in China. The second important factor is export-oriented companies. It should be noted, and I've already mentioned this briefly, that a significant portion of these companies actually earn the lion's share of their income not in China, but in overseas markets, whether it's companies like Lenovo, BYD, Xiaomi, and so on. And as we both know, the global economy is doing well. But despite all this, major Chinese companies are valued significantly lower than their global counterparts. The third factor worth mentioning is corporate reforms. We saw a similar situation in Japan. In fact, the government and Chinese regulators are actively encouraging companies to become more investor-friendly. Towards investors, what does this mean? It means they are encouraging companies to do buybacks or pay dividends. Investors really like this, and as we can see from Japan's example, the Japanese stock market shifted significantly when these reforms started to take effect. China is now actively pursuing this as well. Next, I would like to specifically highlight the potential incentives from the Chinese government, because so far we have seen very targeted and specific stimulus measures. But in reality, in order to achieve the government's goals, given the GDP growth rate in 2026, even at 4.5%, it is likely that the stimulus measures will need to be more extensive. And this will undoubtedly serve as a significant catalyst for the revaluation of the stock market. The next point is that very deflation, or involution as some analysts call it, when companies actively engage in so-called price wars, lowering prices, the thing we briefly discussed earlier. We see that the government has started to intervene in this situation. It is trying in one way or another to limit the price wars that are actively developing in certain sectors of the economy. And this is starting to bear fruit. We observe that companies are beginning to reduce their inventory levels in warehouses, and production capacities are starting to be utilized more actively. So here we are seeing positive signs. This can also serve as a catalyst for future growth, providing additional gains from current profit levels, and for companies, improving profitability, and as a result, positively affecting the revaluation of the company's stock price. Furthermore, it is worth noting that there is a significant probability that the worst situation in the real estate market, its lowest point, most likely, is already behind us, and either we have already hit the bottom or are very close to it. Of course, this is a very important factor for Chinese consumers to start feeling more comfortable and more positive, to look to the future. At the same time, during all that period when the Chinese were not spending, they were building up a huge, colossal base of deposits. And at the moment when the situation improves, when the stock market becomes less volatile and more stable and starts to grow, even if just a small portion of these deposits is reallocated into the stock market, it will amount to hundreds of billions of dollars. And undoubtedly, this will have an extremely positive effect on the revaluation of the stock market's value. It is also worth separately noting the valuations. At the beginning of the video, we mentioned that not so long ago, the forward P/E ratio of the Chinese stock market was around 8.5. That was very cheap. Since then, the stock market has grown, and today this ratio is just under 13. And it is now somewhat, though only slightly, above the average historical metrics. But in our opinion, this is far from the limit for the expansion of multiples. Why? Because today, the average profit growth rate of companies in the Chinese market is about 6%. But according to analysts' estimates, and due to the factors I mentioned earlier, the profit growth rate could shift from 6% to about 10 to 12%, or even higher. In other words, it could double. Based on higher growth rates than the historical average, the PE multiple could very well continue to expand further. And as of today, this is far from the limit. At the same time, if we look not at the absolute value of the multiple, but at the relative one, for example, compared to other developed countries or some other emerging markets, we still observe a significant discount in the valuation of the Chinese market relative to other regions of the world. I would also like to specifically discuss the effect of diversification. In fact, the correlation of the Chinese stock market relative to developed markets is only 0.4. Accordingly, by buying Chinese stocks, you add significant diversification to your portfolio. From the perspective of global investor positioning, the Chinese stock market also looks attractive. It is still significantly underweighted in the portfolios of global funds. Accordingly, if we see signs of stabilization in the Chinese economy, we may well see global funds actively reducing their underweight by buying into the Chinese market. And this is an additional inflow of capital that could enter the market. In other words, we see a huge reserve in the form of deposits held by Chinese investors, which could come into the market. We see enormous potential capital flows that could come from large funds. And all of this, undoubtedly, could lead to a significant revaluation of the Chinese stock market from current levels.
Well, still, Dima, as far as I can understand the situation, all of these various factors you are talking about have not really materialized just yet. And the Chinese economy is still quite a long way from reaching a full recovery. At the same time, the market has already grown quite significantly. So there are definitely some serious doubts about whether this level of growth will continue into the future.
I would say that not all the factors have failed to materialize, maybe only some of them, and we discussed them in terms of probability theory. For example, whether this is the bottom for the real estate market or not. But if we're talking about artificial intelligence, we can see the technologies that companies are implementing. We see how these companies are reporting and how quickly their financial indicators are growing. So I wouldn't say that it's all just at the level of expectations. In other words, there are some really strong fundamental theses that are already being confirmed. But going back to your question, the stock market is investors' view of the future. And as a rule, if we look at it historically, the stock market in countries starts to grow before we actually see a stable economic recovery. That's usually how it happens. And rather, the growth of the stock market is an indicator that the Chinese economy is about to stabilize and move into a phase of growth. That's how I would look at it. But when global investors see in the numbers that yes, the economy has started to grow, yes, China is no longer in a state of deflation, but is beginning to see inflation, then the flows from global slower moving funds will simply intensify, and all of this will lead to an additional revaluation of the stock market. That's exactly how I would view this situation.
If you're currently thinking about where to invest your spare money, I'll give you a very simple answer. Here it is. You should buy the dip in the highest quality assets. Given the situation that's happening in the Middle East right now, in this episode, we've examined in detail all the causes of this conflict and possible scenarios for how it might develop. Be sure to watch this episode and you'll get a complete picture of how you can profit from this. But if you want to adapt your portfolio to the current situation and get through this crisis with minimal losses, and then even make money from it, be sure to sign up for a consultation with our leading strategists.